Hi everyone, welcome to this Financial 101 video series. My name is Victor, co-founder of The Fifth Person. So here at Fifth Person, we help retail investors to look for great businesses to invest in so that they can grow their wealth safely and consistently over time. So today we're going to be talking about what is current ratio and how do you use it when it comes to analyzing a company. So by the end of this whole video, right, you should get a clear understanding of what current ratio is, what is it used for, and how do you apply them. So if you're ready, let's go. So I'm sure that you have come across this term called current ratio. So what exactly is current ratio that we are talking about? So before I move on, I want you to imagine that you are owning a business. And if you are a business owner, right, one of your greatest fear when running a business is running out of cash. So the question here is, how do you know that the company you're running or the company that you want to invest in, right, is running out of cash or having trouble paying off their short-term debt obligation? So the simplest way to find out, right, is to use current ratio, because current ratio measures the company's ability to pay off their short-term debt obligation. And this ratio, right, I can say is one of the most commonly used ratio to measure the liquidity of the company. So let me explain further how is this ratio being used. So current ratio actually helps you to measure the company's financial resources, right, whether it can pay off their short-term debt obligation within 1 year. So the keyword is within 1 year. So I want to think about it. If a company do not have enough financial resources, right, then they will have trouble paying off their short-term debt obligation. It means that the company may go into financial issue, and which force them to sell off all their long-term revenue generating assets, right, to pay off their short-term debt obligation, which is not a good sign actually. So this also means that the company is also not making enough money to support their business operation, or in other words, they are losing money on a day-to-day basis. So this is the formula for current ratio. It's your total current assets over your total current liability. So where can you get this current ratio figure to calculate your formula? So you can get it from your company's financial annual reports, or you can get it from their quarterly report. So right here is Alphabet, which is the parent company of Google. This is their 10Q, which is their quarterly report. So if you look over here, right, this is all the figures in the current assets. Your cash and cash equivalent, your marketable securities, your account receivables, your inventory, and your other current assets. So these 5 items, right, is the commonly found item under the current assets. The rest are generally not so common in general. Then you have your current liability, which is your account payable, your accrued expenses and other current liabilities, and also debt. But in Alphabet case, right, they do not have debt inside. So but usually you can find debt under the current liability. So these are the few common terms figure that you can find under the current liability. So for the current assets, right, they can be readily converted into cash within a year. Whereas the current liability, right, are debt obligation that you have to settle within a year. So you take your total current assets over the total current liability, right? Then you can see in Alphabet case, right, the current ratio is about 3.9 times. It means that the company have a current asset of 3.9 times more than their current liability. So this company, right, Alphabet, right, they are in a very, very comfortable position to clear off their short-term debt, and they unlikely will go into any financial issue. So in general rule of thumb, right, we want to look for companies with current ratio of at least 1 time or more. Of course, the higher the number, the better it is for the company to pay off their short-term debt obligation, which is like in Google case, it was 3.9 times. Let's move on. So in summary, right, if let's say your current asset is 1 million and your current liability is 1 million, so you say to have a current ratio of 1 time. So this means that the current assets are just enough, right, to pay down their short-term debt obligation. So in this case, it's still in a good position. Then you have another case where your current asset is 2 million and your current liability is 1 million. So it gives you a current ratio of 2 times, which is more than 1 time. So this is the most desirable situation that any business owner want to be in. Okay, so if you go to a bank, right, the first thing they look at is also your current ratio, whether are you having a high current ratio so that they can lend you more money. So this is the best and most desirable situation that you want to be in. Then you have those situations where your current liability is 2 million, whereas your current asset is 1 million, which gives you your current ratio of less than 1 time, which is 0.5 time. So in this situation, right, I would say it's a problem situation at hand for some companies, that they may not have enough money, right, to pay off their short-term debt obligation. So next I want to tell you is that every time when you use current ratio, right, it's best used to compare current ratio with their industry peers. You don't compare, let's say company A is in the service industry, company B is in the shipping industry. You don't compare their current ratio together. It's totally different. So you focus on the individual sector and compare with the same competitor. So for in this case, right, let's say Facebook, Snapchat, Alphabet, and Twitter, they are all in the technology industry. And 4 of them, right, they make their money through advertising. So they are rather same in the same industry. So if you look at Facebook, right, their current ratio is about 4.7 times. Snapchat is 7.3 times. Alphabet is 3.9 times. And Twitter is about 8.7 times. So it doesn't mean that you have very high current ratio, you are very good. Okay, it's all about balance. You cannot have too low and you cannot have too high. If you have too high of current ratio, it means that the company is not very efficient in managing their current assets, or they are not managing their working capital well. So you need to track whether what is consists inside their current assets. Okay, so is it more receivables and inventory or mostly cash? So let me give an example. So let's say now I have 2 companies. Company on your left and company on your right. So both companies have current ratio of 2 times. So both of them have the same current ratio. The only difference between the company on the left and the right, is that the company on the left, right, majority of their current assets are stuck in inventory and receivables. Whereas on the right, majority of the assets are in cash. So which company will you prefer? Company A on the left or company B on the right? Definitely company B, am I right? Company B is more favorable compared to company A because they have cash, which is already a very liquid asset, and they can easily pay off their short-term debt obligation. While you look at company A, right, their majority of the assets in receivables and inventory, which you need time to convert into cash and then pay off their short-term obligation. So this is some of the things that you want to look at when you analyze or compare different companies using the current ratio. Next is that it's best to use current ratio, right, in terms of trend, but not in terms of a standalone absolute figure. So if you look at Alphabet, right, I have plotted out the trend of their current ratio from 2010 all the way to the latest 9 month 2019. Okay, so as long as most of the years, right, they are above 1 time, right, it's generally a good sign for the company. But I want you to be careful of companies, right, where their current ratio are decreasing until they drop below 1, or they are consistently below 1. So you need to check what's the issue. Why are they below 1? Okay. And the next thing is, I also want to tell you some exceptional case for current ratio. Current ratio does not actually paint the full picture of the liquidity of the company. Okay. So like I said, a current ratio does not always means a company have liquidity issue. There are exceptional cases where company is able to have low current ratio if it's backed by strong recurring operating cash flow. By now, you should have a clear understanding of what is current ratio and how do you apply them when it comes to analyzing a company. So in summary, current ratios tells you the liquidity situation of the company. And be careful of current ratio that is consistently below 1. And a general rule of thumb is that we want to look for current ratio to be above 1. So now if you are into investing and you would like to find out how you can find companies that can help you to compound your money at 10 to 20% a year, we have a free training for you at the Quadrant Strategy. So you can find the training link in the description box below. And finally, if you like this video, right, do remember to hit the like button below, share with your friend, and don't forget to subscribe to this channel for more videos and updates. Thank you for watching, and I will see you in the next video.